Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right, hey everybody, welcome to this presentation. Take Back Control Tuesday is what we call this event. Now, why is it Take Back Control? Well, what we're gonna be talking about here today is about that. It's about, taking back control in our lives. But for those of you that don't know me, my name is, I'm Brian Fouts. I'm part of the Chris Naugle team, the BYOB team, the Money Multiplier. And I'll share a little bit about myself as we get into this. But yeah, as I said before, hit the record button. I live in northern Idaho now. A lot of you have seen me before. I used to live in Washington State, central Washington State over there. But yeah, we just moved our family, and it's going to be an adventure. All right, let's go ahead and get rolling here. Now, before we get into this presentation, I want to ask everybody here a question. What in life should you control, or should you want to control? Now, there's three things, and I know quite a few have been on this presentation before, but if you have not been on this presentation before, actually, by the way, if you're new, haven't seen this presentation, or new to the Money Multiplier, new to our campfire, as we call it, give me a one, give me a yes in that chat box. Let me know that this is one of the first time you're seeing this presentation, first time you're seeing me. I'd like to see how many new people we have on the call. Robin, Juan, okay. Mario. Awesome. So we got some new people. I love that. So I like to see how many people we got that are, seeing this for the first time. Because we're sharing this. Walt, Jeremy, very cool. Awesome. Love it. Thanks, Walt. Very cool. Okay. So let's go back to the question here. So what in life should you control? What do we want to control? Now, someone said time. Absolutely. Time is the big one. What are some other things you might want to control? Now, there's three things that I believe that are kind of the paramount ones, the big ones. A lot of people will say health. Yes, health is a good one, but there's things. Yeah, finances. Yeah. So the first one I always say is money, because when we think about controlling things, we think about money. That's right. Freedom. Exactly. Walt says freedom. Now, what can money do if we control money? Well, money can allow us to control the other thing that I believe is one of the top three, and that's time. Someone said time. Because a lot of people say, oh, how do you control time? One of the best ways to do that is to control money. So as an example, I'm an entrepreneur. I'm an investor. I've owned lots of businesses, and that's allowed me to control money. But more importantly for me, time is the biggest one for me. I love to control my time. A lot of you have seen me do this presentation while in a motorhome traveling with my family. I can do this wherever I want, so I kind of built that freedom. Now, there's one thing though, before you can control money, before you can control time, there's one other thing that you have to control. And a lot of you probably know what this one is, and that's your mind. That's your mindset, okay? Because if you don't have the right mindset when it comes to money, it's very hard to control it. As an example, we're taught from a very young age to trade time for money. So and I used to have a W-2 job. I worked in corporate America, and I realized I didn't control two things. I didn't control my money. I had an employer that controlled it, and I didn't control my time. I almost got fired because I tried to go on vacation that was approved. They almost fired me one time. I realized I didn't control those two things, but the reason why I didn't control them was because of my mindset. And so as we go through this presentation, what I want to challenge everybody here to do is to keep an open mind, right? Keep that open mind as we go through and learn these different things, okay? Now, this is a quote that we here at, as part of the Money Multiplier and BYOB like to share. And this is from Will Rogers. And this quote says, "The problem in America isn't so much what people don't know, it's what they think they know that just ain't so." Now, so once again, keep an open mind as we go through this, because most likely you've been taught something around money that might not just be true, but we think it might be true, but it's not. So open mind. All right. Now, I want you to think about something. Now, this is a very interesting kind of, story. So let's say you have 118-year-old kids. So 118-year-olds in a room, and you gathered them all together and you said, hey, where are you going to be when you retire? What's your life going to be like? Now, they're all going to say, I'm going to be wildly successful. I'm going to be a millionaire, maybe even a billionaire. I'm going to be successful. All the kids are going to say that for the most part. Now, here's the scary thing, though. When you fast forward to retirement age, maybe age 65, whatever it is, only five out of those 100 kids will be financially secure in retirement. So 5%. Okay, that's crazy. Here we are in America, North America, one of the wealthiest countries in the world, yet only 5 out of 100 people in our population are going to be financially secure later on in life. And I'm not talking financially free, by the way, just secure. So let me ask you another question. Do you want to be one of those 5%, one of those 5 people? If so, give me a 1, give me a yes, give me something in the chat box, because that's really what this is about. This is about how do we be one of those 5%, not the 95. We want to be one of the 5%, okay? And by the way, not even financially secure. I want to be financially free, right? So yes, so Juan says yes. Anybody else say yes? Anybody else want to participate? Yep. Deborah, I am, and I want to grow it. Absolutely. Absolutely. So this is about how do we become one of those 5%. Make sure that we have that security for later on in life. All right. Okay. So now there you go, Mario. Walt says 1. Now here's the thing. That statistic right there, it comes from the Social Security Administration. I didn't make that up. They say that 5 out of 100 people will be financially secure at retirement age. I mean, that's a real stat right there. And that's just nuts. Okay. Now, before we dive on into it, who am I, right? So who's Brian Fouts? So for those of you that know in Washington State or this area, I went to Washington State University, go Cougars. I got a degree in construction management and business. Now, why did I do that? Because that's what I was told to do. It was just drilled into me from a young age, get good grades or try to, and go to school. So that's exactly what I did. I followed that traditional path. I call that, by the way, the hard way, okay? I was raised lower income. I remember, at my family's home, my parents still live there, by the way, but we had to go downstairs and start the fire every morning when it was freezing cold because they didn't want to turn on the heat because it was too expensive, like that kind of stuff, right? So I remember I hated getting out of bed in the mornings when it was like 30 degrees outside. It was so cold, but that's how I was raised. But great upbringing, all the kind of stuff. But I followed that traditional path in life. That's just what I was told to do. So get good grades, try to get good grades, go to school, get a job. So I went to corporate America. I had a 401k or 401 chaos, as I prefer to call it, from my one of my mentors, Andy Tanner. But that's what I was doing. And I had that house. I had that growing family, and the white picket fence, as they call it, right? The American dream, I was told, oh, you're doing it, man. You're doing it, Brian. Good job. But it felt like the American nightmare, to be honest, because I was drowning. I felt like I was just drowning. I wasn't happy with what I was doing, my career. And I was at a doctor's office at one time, and I picked up this magazine. It was a financial magazine, something like that. And I turned to some article, and it was talking about how millionaires know their net worth. And I was like, well, wait a second. I don't know mine. I'm obviously not a millionaire. So I went and did the math on a piece of paper later on that day, that night. And that's the actual paper there. I lost it, but I took a picture of it one time. But I was worth a negative amount of money after 10 years of working in corporate America. And I realized that this is not working. So I realized I had to do something different. I had to figure out something different to do with my life. So I was like, what the heck? But I didn't really do anything different at that point in time. But I had an event that happened. And, we all have these sort of catalysts, and they're all personal stories usually. And so mine was this. So I had my grandfather. He was a coach and teacher at the local high school. He taught my father, he taught my older brother, and then he worked really hard. He's one of those pillars of the community kind of people, right? That person that everybody looks up to, very well known. When he passed away, there were thousands, there was like 1,000 or 2,000 people at his funeral. It was crazy. But I looked up to him, and he was working really hard to retire. He wanted to retire in his 60s and then go get a motorhome and travel around with my grandmother, his wife, and go to sporting events. And he did that. He actually retired finally. He worked pretty late, retired, got the motorhome, and then not even 2 years later, got very sick. He had Parkinson's disease and very advanced leukemia and a couple other things, dialysis, and ended up passing away. He never really got to live that retirement that, I was all told that, hey, this is what you're working towards. So it made me realize that if I want to live my life today, I got to do something different, because I didn't want to work and then not be able to live, life that I wanted down the road. So that was a big catalyst for me. It's kind of personal story right there. But that's what I did though. I left that corporate job. I went into business. I bought businesses. I raised capital, did real estate, did a lot of things, and had a lot of lessons learned. But anybody can say anything on the internet. So this is one of my businesses. This is in 2021, the second year of COVID, by the way. I think that one grew to over $2 million in revenue before we stopped that business. Made the Inc. 5000 list. It was kind of cool. So that's the kind of stuff that I realized I can do. And you can do it too. And along that road, I learned about this concept that we're going to be talking about here today. But that learning these things and learning that concept, it allowed me to control one thing, especially for me, and that's time. So I love experiences in life. I really love experiences. And you can see here, these are, I'm a car guy. I like classic cars. I have classic cars, but I've been able to do a lot of fun things in life. And this concept that we're going to be talking about here today has helped me do that. And I've helped thousands of people learn about this concept as well. But because of what I've done, I've actually spoke on stages, spoke to high-level masterminds. That's one of the masterminds I used to go to. But I would speak and teach this concept to a very high-level individuals and everybody else in between. So this is really what my passion is. I love to talk about this concept. I love sharing it and helping other people see how it can impact your lives. All right. Now, one thing I want you to understand, though, what I'm going to be covering here today, infinite banking, that concept, it is not a new concept. It's been around for a very long time. We're talking hundreds of years, been around for quite some time. And there's a lot of people that use this. And so who else uses this or talks about it? So everybody heard of Robert Kiyosaki? So one of his advisors was my mentor within this concept. That's where I learned it from. And I've worked with a lot of his advisors personally. But Robert Kiyosaki, in his book, Second Chance, talks about this concept. This guy, Tony Robbins. So I've been to Business Mastery and Unleash the Power, a lot of his events, but he talks about it in his book, Money Master the Game. He talked about this concept as well. And then, of course, there is Nelson Nash, Becoming Your Own Banker, Unlocking the Infinite Banking Concept. That is one of the number one books that we all recommend to read about this concept, because he's the one that coined the phrase infinite banking concept. Then, of course, we have Brent Kessler and Chris Naugle. They're some of my mentors and who I work with. Mapping Out the Millionaire Mystery. It's a great book. And then Chris Naugle has the Private Money Guide as well, talking about how to use this concept in the private lending space. Now, if you guys want the Mapping Out the Millionaire Mystery and the Private Money Guide for free, PDF, I do have a link that I'll share with it a little bit down the road, and some other resources, free things that we give out to you. So just keep that in mind and remind me to put the link in the chat box here in a little bit. But those are some good books. I definitely recommend reading some of these books if you have not before. All right. Now, who has used this strategy throughout history? Okay, so who has used this? Well, Jim Harbaugh, I can never remember how to say his name, but Jim Harbaugh, he was paid through this concept. So the college paid him his bonuses, his salary through this concept, cash value life insurance, as they call it. And he was one of the highest paid coaches at that time. But there's a reason why they did this, of course. Who else uses this? Well, this gentleman, he might not remember that he even has these things, but Mr. Joe Biden, president, currently, he actually has, I think it's 6 of these policies, or 2 with his wife, but he holds a bunch of these policies, and he had to disclose that when he became president. Disneyland. So Walt Disney, this is kind of cool. So Walt Disney wanted to start Disneyland, but nobody would give him money. Nobody would give him any kind of financing when he was trying to start that business. He went to bank after bank after bank, and they all said no. But he had this concept in place, so he borrowed from it, basically self-financed the beginning of Disneyland. So we wouldn't have Disneyland as we know it without this concept. Also, Ray Kroc, so McDonald's hamburger. So when Ray Kroc took over McDonald's back in the 50s, he used this concept to fund the growth of McDonald's for the first 8 years. And so we might not even have McDonald's if it wasn't for this concept as we know it today. Pampered Chef, she borrowed some money from this concept to start Pampered Chef, and of course, Warren Buffett, I think he acquired it for like 700 million or 1.5 billion. I mean, that's just incredible right there. But then, of course, a lot of wealthy families use this concept. And I've talked to a lot of personal wealthy families about how they use it to learn how they're doing it. But JPs, the Morgans, Chases, Vanderbilts, the Rockefellers, all those people, and now you. So definitely a lot of people are using this concept and throughout history have used it. All right. Now let's kind of talk about what infinite banking will do for you. So why would you want to do this? What can it help you accomplish? So one of the first things that this concept does day one is it creates guaranteed generational wealth day one. I love the word guaranteed, by the way, so I'll be saying that quite a bit, but guaranteed generational wealth day one, not year 40, not year 30, but day one, it's guaranteed, by the way, tax-free. So that's a really cool benefit right there. It allows your money to grow uninterrupted, compounded for the rest of your life, guaranteed. So one of the things that I'm going to be showing you as we go through the presentation is what uninterrupted compounded interest is. Like when your money grows uninterrupted, that's one of the most amazing things you'll see, because other investments like a 401k in the market, they're volatile. They are not uninterrupted. They are interrupted compounding. So that's a term that I like to make sure that everybody's clear on. So it takes control of your money away from the big banks and Wall Street and puts that control into your hands. Remember when we talked about control at the beginning of the presentation? This is what this allows you to do, to put that control back in your hands, because a lot of us are just taught to give control away of our money. We give control of our money away to big banks, to Wall Street, IRS, by the way. This puts that control back into your hands, which is a big deal. It protects your money from lawsuits, bankruptcies, divorce, and creditors in most states, by the way. So protecting your money is one of the more important things that a lot of people don't think about until it's too late. So wealthy families that sustain wealth over generations, they understand you've got to protect that money. And this is one of the ways that they do that. Now, this is why we call it the infinite banking concept. It allows you to be the bank for things that you may normally use a bank for, such as real estate investing, college, cars, homes, investments, retirement, while still having all the benefits listed above. Typically, it's one or the other, but this does all of these things all at the exact same time. So give me a one, give me a yes in the chat box if you would like to have all of these things in place in your life at the exact same time, right? Do you think this would help you build, wealth, or help you make more money, or help you put your money to work in a more safe manner? Yeah, definitely. Agreed. Yes, absolutely. So that's why we call this some people call this the and method. It's not one or the other. It's all of these things. You're doing this and that, not this or that. Make sense? Okay. All right. Now, what I want to mention is as we go through this presentation, as we go through this presentation, ask questions. That's what that chat box is for. That is what the Q&A box is for. Make sure you take or not take notes, but ask questions. I'll stop here and there to answer questions. So this is a live interactive presentation. So yeah, once again, please ask questions as we go through this. 1A, well, yeah, we'll talk about that. It's down the road, but keep in mind, there's nothing to purchase here. I'm not selling you anything on this presentation. I'm here to give you value, help you understand this. And then if you want to have a conversation, we can do that. All right. Now, I want to share with you this analogy here real quick. So who learns quickly? Well, kids learn very quickly, right? And so you probably learned to ride a bicycle when you were a kid. And if you did, right, it's pretty easy to hop on a bicycle later on. Even if you haven't ridden one in years, to hop on it and ride that bike. You pedal, it goes forwards, turn the bars to the left, it goes left. Make sense? Okay. So what would happen though if the bike did not work that way? What would happen if you hopped on a bicycle and you turned the handlebars to the left and the tire went to the right? And by the way, it's called the backwards bicycle. You can Google the video on YouTube. It's hilarious. Do it after this presentation, though. But it's very funny. So this guy tries to ride the backwards bicycle. He hops on and he immediately falls over because he can't ride it because his brain does not understand that, hey, it's the opposite now. And so it takes him, I don't know if it's like 6 weeks or 6 months to learn to ride the backwards bicycle. So you have to retrain his brain and his body to ride the backwards bicycle. But what's even more interesting is this. So when he got back on a regular bicycle, he can't ride that one anymore because he's now retrained his brain. So when he gets on a regular one, he falls over again. Okay. So why am I sharing this? Well, it's the same thing around money. Okay. We're taught how to ride the regular bicycle, which might not be the right way to do it. But when we open our mind up and we can learn to ride the backwards bicycle or learn a new way about money, right, we can change our lives. So it's a funny video, backwards bicycle, go do that one. But one of the things we're going to be talking about that's very different is where your money goes first. Okay. Now, why am I talking about that? Because when our money comes in, we immediately have it go out to other people. But we're going to talk about how to rethink or train our mind to think differently about money, and where it goes first is very important. Okay. So why aren't more people successful, especially when it comes to money? So here's the mysteries of money. So here's the wealth killers. Okay. Taxes. Now, I don't mind paying taxes, but I'm a lot happier paying a lot less, but they can kill wealth. Inflation, that hidden tax. Now, inflating, by the way, is not rising prices. Inflation is the inflating of the money supply, which is what the banks do and the Treasury does, which then eventually leads to rising prices. It takes a couple of years, but that's what inflation does. It kills wealth. Volatility. If you have your money in volatile assets where you're going up and down, it's very hard to build sustainable wealth or have security or certainty around your future value of your money. Interest. We're going to talk about interest. Interest, when you have debts and all those kinds of things, just sucks money out of your hands every single month. Also, mindset. So following that status quo, that's what I did for years. Fear. So fear can often lead you to not be successful because you don't take action on new things. Even if it might be the right thing to do, fear keeps us held back. Life in general. I mean, life, as we go through life, what we're taught, by the way, all those kind of things create that mindset that can actually lead us to not be as successful as we want and leading us to not have that wealth we want. Okay. So what is the definition of money? So as we go through this, definition of money is just a means for exchange. I don't care if it's, dollar bills, shells, or seashells or whatever. It's just a means of exchange. Okay. Also, compound interest. So think about what compound interest is. So what company uses it? Well, do banks use compound interest? No, they don't. They charge you interest, but they don't use it themselves in the same way that we're talking about. Because if you write your name on a $20 bill and give it to the teller at the bank, they don't put it in a box and their name on it in the back. They put that money into motion because money in motion makes money. And so there really is not a business in the world that uses compound interest uninterrupted, by the way. Okay. Also, are your dollars worth more today or in the future? So think about what you could buy with a dollar bill today versus 20 years ago. Think of like candy or a candy bar. You can go into a candy shop with a dollar bill and come out with like an old bag of candy. Now you come out with half of the Snickers bar, right? So your dollars are worth more today than they are in the future. Okay. Do taxes go up or down? Kind of a funny question, but yeah, taxes go up. They usually don't go down. Okay. So I want to think about that because what I want you to think about, let's say you're a farmer and let's say you're going to go buy some seeds. Okay. You're going to plant those seeds and then you're going to harvest down the road. You're going to reap the harvest. What would you rather pay taxes on? The seed or the harvest? Okay. So think of it. What would you rather pay taxes on? The seed or the harvest? Now, this is a good question to think about. The seed. Yeah, Terry said the seed. Now, why is the seed? Well, if you buy seeds for $1,000 and pay taxes on the $1,000 and the harvest is worth $100,000, of course you want to pay the taxes on the $1,000, not the $100,000. Okay. But guess what? A 401k is the opposite. A 401k is paying taxes on the harvest, not the seed. See? Now, why would you want to? Now, who wants you to actually be taxed on the harvest? Well, the IRS, of course. That's why you add 401k. That's why they're deferred. Keep that in mind. Now, would you wait to eat bread or milk? Now, this is kind of a weird question, but let's say you go and buy some bread and you put it in the freezer for 5 years. When you open up the freezer, there's 2 loaves of bread. They're both going to taste kind of crappy because they've been freezer burned. But that's what we're doing with our money, by the way. We're literally doing things with our money that we wouldn't do with things that money buys. Now, what do I mean by that? So let's say would you go and buy a car, park it for 10 years in a garage, never drive it, and then go drive it 10 years down the road? Of course not, because you need to use that right now, okay? But yet we put our money into a 401k or IRA or other vehicles, and we can't touch it for years and years down the road. So we do things with money that we wouldn't do with things that money buys. It's a weird thing when you start to see that. It's very strange, okay? And then what do you know about your retirement account? So what do I mean by that? So think of like a 401k and IRA. You're literally giving up, good dollars today for weaker dollars down the road, and you don't control it. So when you look at a 401k, those kinds of things, if you have to understand how they function, it sometimes doesn't make sense. But what are the other options? Well, we're going to be talking about those other options. Now, when it comes to your retirement account, who controls it, by the way? Remember control? It's not you, by the way. The banks control it. The Wall Street controls it. The custodian controls your money. You're giving away control of your money. We talked about control. What do you want to control? A lot of people said money. Okay, well, if you're doing those other things, you're giving control away because we're taught to do that. Just kind of keep that in mind. All right, next up, we're going to talk about how money flows. So this is kind of starting to get into the concept. All right, so let's just say that you are going to go buy a car. Let's say it's a $25,000 car. It doesn't matter what kind of car. Let's just say it's $25,000, okay? Now, let's say that you have $25,000 of cash sitting at your local bank, and that money is earning 4% right now. So that's pretty good, okay? But let's just say that's a scenario. And you go to the bank, you go to the banker, Mr. Banker, and you say, Mr. Banker, I want to take $25,000 out, and I want to go buy a car with cash, okay? Now, the banker says, well, wait a second. Rather than having you take out the $25,000 cash, how about you leave the $25,000 in the bank and I'll pay you 4%. And I'll give you a loan of $25,000 at 6% for 60 months. And I'll use your cash in the bank as the collateral. Okay. So now you've got $25,000 in the bank earning 4% for 60 months. And you've got a loan for $25,000 that you're going to be paying off over 60 months at 6%. Okay. So how's the math work? It's just math, by the way. The monthly payment on the car is $483. Okay. That future value of those payments is going to be $28,999. $29,000, round up $1, right? Now, here's the crazy thing. What's the future value of the money in the bank? The future value is $30,525. So you've made $1,526 by doing it this way instead of just taking the cash out and paying it with cash. Now, why is that? Why is this possible? It's because of math. Now you're earning compound interest on the bank money in the account. So that's earning 4% on top of a growing balance. You're paying 6% though. So people say, well, there's a 2% spread, but it doesn't work that way because you're paying the loan down. That means that 6% is on a decreasing balance, a smaller balance. So the purpose of this is, once again, mindset, is that you can make more earning 4% while paying 6%. It's a strange thing, but math is just math. So once again, you can make more earning 4% while paying 6%. Okay. So here's the topic we're going to be talking about. So the first one is going to be the machine. We're going to talk about what the machine is that allows infinite banking to exist. We're going to talk about the marathon because this is not a sprint. It is a marathon. Okay. And then the last thing is everybody's favorite topic. How do you build wealth? The millionaire. How do you use this concept to start building wealth in your life? All right. Okay. So let's talk through the machine. All right. So what is the machine? The machine is nothing more than a dividend paying, permanent, by the way, whole life insurance policy from a mutual insurance company. So what does that mean? Okay. A mutual company means that it is a private company, not a stock company, and is owned by the policy holders, you and me, which is why it pays you annual dividends, right? That's the uninterrupted compound interest. You're earning dividends on what you put into this concept. Okay. Now, you might be thinking, well, life insurance, I mean, why do I need it? I'm young or whatever, or I don't need life insurance, etc. But here's the thing. This is about how to have a living benefit within this. Okay. Now, here's the thing. Banks use this, wealthy people use this, businesses use this. It is not a new concept. So you just got to keep that open mind. Now, if you don't believe me, go look up BOLI. It's called bank-owned life insurance. You go ahead and Google it if you want. It's called, BOLI right there. And you'll find that banks, they own more whole life insurance than all of their real estate and buildings combined. So once again, big banks own more life insurance, whole life insurance on their employees and things than they have buildings and real estate combined. So how are they doing that? How are they buying it? They're using your money, by the way. So they're taking their money that they have inside the accounts and they're doing this concept. So all we're doing is essentially bypassing the banks and doing one of the things that they're doing with your money already. Okay. Yep. Now, one thing to keep in mind is that this concept has been around longer than the IRS has been around. Like, that's crazy. Like, this, once again, this is established. It's been around for a long time. And it grows tax-free, by the way, with guarantees. And those are two things that we absolutely love. All right. So let's kind of talk about this. So once again, I'm going to come back to this really quickly. So the question is, can you make more money earning 4% while paying 6%? Well, yes, I showed you exactly how that can occur, right? So once again, it's just math. So now let's kind of look at how banks function, because if we're going to be talking about becoming our own bank, we need to understand what banks do, okay? So let me ask you all a question. Why do banks exist? Think about this for a second. Why do banks exist? To protect and loan money. Okay, that's a good answer. I like that one. Okay, Yvonne, yeah, I know you've seen this before. Yeah. Anybody else? To get the spread on your money. Okay. Anthony, I know you've seen it before too. That's a great answer right there, by the way. So Yvonne and Tony nailed it. So it's to make money. Like, banks exist to make a profit. I mean, bottom line, that's what all businesses want to do. They want to make money, okay? But they do that by making money off of your money. So what does that look like? Okay, let's look at it very quickly. Okay, so let's just say you deposit, let's say $100,000 into a bank. Let's say that bank's going to be very nice and they're going to pay you 4%. Okay, that's cool. All right, so they're going to pay you 4%, but that's a liability for the bank. So on their balance sheet, you have assets and liabilities. That's a liability for the bank. Now, they can't function off of liabilities. They have to have assets. So that's what they do. So they take your money and they loan it right back out. So maybe they do it on a mortgage or something, or a HELOC or something like that at 7%. Now, what does the seller who sold the home do? Well, they take the money and put it right back into a bank again, usually. Okay. But once again, the money is not just sitting there, it's put into motion, because remember, money in motion makes money. That's what the bank does. So they take that money, put it right back out. Maybe it's the car loans at 8%. But what's the dealer do? Goes right back into a bank in most cases. What's the bank do? Money in motion, right? Maybe on a home remodel, those are kind of expensive, right? Maybe the contractor puts the money back into the bank. Maybe his subcontractors do that, right? They put it right back into the bank. What's the bank do? Maybe debt consolidation. They're always put that money into motion, right? Credit card companies put it right back into the bank again. So that's what's happened. And the bank is doing all of these transactions, just flowing the money through other things, creating all of these assets off of your money, okay? Right? To the point where if you do the math, they're making 500% more off of your money than they're paying you. Like, that's incredible, by the way. It's just math, by the way. Now, did I make this up? Nope. You can go to BauerFinancial.com. Banks make between 400 and 1,300% on the money that you leave there. Okay, that's crazy. But you can go to Bauer Financial and you can go back in history and look to see how much banks have made off of your money. Now, you might be saying, well, Brian, if that's the case, how come banks have gone under? Think of the Great Depression. Half the banks went under. It's because they do something called fractional reserve banking, and they over leverage, and then you can have a run in the bank, and they cannot support that. So there's other things that they do are not good, but this is something that they do to make a lot of money. Okay, so kind of funny when I now that I know this, when I go to a bank to make a deposit, I kind of like it. Just, I'm not comfortable, right? I don't like my money sitting in the bank because I know what they're doing. I know they're making money off of my money, right? And so it's why they have those little suckers next to the tellers, the dum suckers. Like, that's what I feel like sometimes when I leave my money sitting there. I'm like, oh man, this is not the best place for it. But once again, mindset, right? Mindset. All right. Now and remember I talked about how where your money goes first is very important. Let's kind of talk through the annual pattern of spending, how we spend money, because this is going to start to kind of get you guys thinking about how infinite banking can change these things in your life. So let's talk about automobiles. So let's say $1 comes into your house, into your hands, your bank account. So 20 cents of every dollar that you have that comes in goes out to automobiles. Think of payments, gas, upkeep, tires, all that kind of stuff. 30 cents of every dollar goes to housing. That's quite a bit, right? But think of that. Think of mortgage or rent or that kind of stuff. Okay. Now, 40 cents of every dollar goes to everything else. Think of things like travel, entertainment, food, clothing, all that kind of stuff, right? Now, at this point, 90 cents, that's 90 cents right there, by the way. 90 cents of every dollar is going to someone else, going to somebody else, meaning you do not have that money anymore. It's in somebody else's hands, all right? And 10 cents of every dollar goes to savings. Now, about 3 years ago, I think the average savings rate was like 5 to 6%. Before COVID, I think it was like a negative number. I don't know what it is, today, but man, unfortunately, not a lot of the money goes to savings. Now, I'm not going to sit here and talk to you about what you're saving, by the way. Now, but if you go talk to a traditional financial planner, they're going to ask you about what you're saving and then what to do with that money. Okay. They're not going to talk about the rest of the money. Right. So, and I remember this because I used to have a financial planner, and that's exactly what he did. Okay. Now, what we want to do is take away risk from our money, but take back control of it as well. Okay. So here's why. So let's start with the savings. Now, remember, 10 cents goes to savings. Now, if you look at the car, the automobile, 20 cents of every dollar goes to that. But here's the thing, 5 cents of that 20 is interest. So let's take that interest and let's recapture it and put it back into our savings. Okay, pretty cool. Now, let's look at home. Okay, housing. Now, if you have a mortgage, an amortized mortgage, a lot of people know this, but it's front loaded with the interest to the point where, okay, if every dollar 30 cents is going to housing, 25 cents of that is interest. That's kind of scary. That's because in the first 7 years, around 80% of your payments goes to interest. That's an amortized mortgage, by the way. Now, why is it the first 7 years are high interest? It's because the banks built these that way because they know the average family moves every 7 years. So why they create an amortized mortgage that's front loaded for 7 years? That's exactly why. And by the way, if you've ever had a bank call you and say, hey, you can refinance and get a better rate. You reset that debt clock, the interest clock. Refinancing is one of the, I don't want to call it a scam, but man, it is dangerous if you don't understand how much more interest you're going to pay by refinancing. It is literally one of the things that banks do that steals wealth, in my opinion. Okay. But yeah, so kind of keep that in mind. All right. Now let's recapture 25 cents of that 30, put it back in our savings. Okay. Now, the last thing we talked about is everything else. So of everything else, 40 cents goes to that. And about 5% of that roughly is on interest. So let's recapture that interest back into our savings. Okay. So now what have we done? So we've recaptured that interest back into our savings. So imagine that if you had $1 coming in and that much went to your savings instead of going to somebody else, could you build wealth faster? Well, yeah, one of the ways you can start to do that is by becoming the bank. This is what will happen.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
What I want to show you right now is an example of how infinite banking can do this. So let's look at an example of a car. Now that's obviously a nice car. That's a Mustang right there, Eleanor. But let's look at how you can get all the money back for every car you ever buy, drive, and own. Okay. Now, what you're going to see here is a policy illustration. This is a simplified version of what's called an illustration or tabular detail. So on this, you're going to see a few things. You're going to see the policy year, age, and deposits. Now, why do I say deposits? Well, when you have a policy, infinite banking policy, there are premiums, but we call them deposits. Why is that? Because you're depositing it into your bank that you can then borrow back out again. So we're going to call those deposits. All right. Additionally, age. A lot of people say, well, Brian, okay, I'm too old or I'm too young or what? How does age impact this? It doesn't matter as much as you think. Just keep that in mind. What it mainly impacts is what's called a death benefit. But I have clients that are 18 years old, 1 year old, and 71 years old. Okay. So I've got clients everywhere. And I even have clients that are 70 in their late 70s doing this concept in a different manner, but you can do that. Okay. Death benefit. We're not going to focus on death benefit. A lot of people, yeah, there you go. And 60 years old. Yep, there you go. But a lot of people think about death benefit. Like that's what they're tied to when it comes to infinite or life insurance. Okay, but here's the thing. I want to talk about the living benefits, not the death benefits. Living benefits. So we're not going to focus on the death benefits. We're going to talk about it. But once again, we want to look at the living benefits. How do we use this throughout our lives? Okay. All right. So here's an example. So we're going to open up an infinite banking policy. Once again, this is just an example. Okay. And these are very conservative examples. We're going to deposit $10,000 into this policy each year for the first 7 years. Okay. That's our premium deposits. Now, as we deposit money into this policy, we're going to get what's called cash value, meaning that we can start to borrow out of the policy right off the bat. Okay. Now, once again, being very conservative. So as we fund the policy in year 3, as an example, we're going to go purchase a car. So we're going to go to our bank. We're going to get a loan out of our bank for $25,000, and we're going to pay ourselves back, back our loan. That's called being a responsible banker. So let's use an example of $500 per month, a 5-year payback period, 60 months. That's $6,000 per year. So there it is right there on the screen. So what's the totals right now? Okay, so what did we put into this banking system, this infinite banking system? Well, we put in $70,000 of deposits. We also put back into it $30,000 via the car payment back, right? So that's $100,000 that we have put into this policy in the first 7 years. But keep in mind, we also took out $25,000. So we had $25,000 of cash, and we could have done anything with it. We bought a car in this example, okay? So, but you could have done something different, but let's just say a car. All right. So we had that in cash. So in reality, $75,000 is what we have put into this. Okay. Now, if you understand what's happened right now, is that we have recaptured, because we have $67,000 of cash value in this policy versus $75,000 in. We've recaptured 91 cents of every dollar so far. Okay. Now, let's look at years 8 through 12. Now, in years 8 through 12, we're not going to put anything else into the policy. We're not going to put any more deposits. That's an optional thing, by the way. Now, in year 8, we're going to do the same thing. We're going to buy a second car. We're going to do the exact same thing, though. We're going to borrow 25. We're going to pay it back at $500 per month, $6,000 per year. So in years 8 through 12, how much have we put into this thing? Well, $30,000, right? But don't forget, we also had cash. We took $25,000 of cash out. So we had cash. So in reality, we only put in $5,000 into this thing. Yet guess what? Between years 7 and years 12, the value of your banking system grew by $23,592. You only put in $5,000 though, but it grew in value. And yet you also got a car. So now if you look at the math here on the screen, I'm going to just really quickly explain this. So over the years, over 12 years, you've put in $75,000 plus 5, that's $80,000. Okay. The cash value that what you have access to is $91,000, being very conservative, by the way. So you have more available than you put into this, and yet you also own 2 cars outright. So if you just taken cash and bought those cars, you'd have spent $50,000 and have no cash and own the 2 cars. In this scenario, you have $91,000 of cash value in your banking system, and you own the 2 cars outright. Now, once again, if that math is kind of confusing, we can do a one-on-one call and I'll explain to you, but this is extremely powerful. So you can do this over and over again. But what the point is that your money does not lose value. You keep control of it and it keeps growing for you. Okay. All right. So 3 rules when it comes to infinite banking. 1, pay yourself first. So in this scenario, instead of going and buying the car first, we put it through our banking system first. So we recaptured the money first. Okay. Pay yourself back with interest. In the car example, we paid our own banking system back with interest, by the way. But as you can see, we benefited during that process. And third, recycle and recapture your money. What that means is don't let it go out of your hands. Recycle it back into your policy, recapture your money, and keep the process going. Money in motion makes money. That's what number 3 is right there, is keep that money in motion, okay? All right, if this works for cars, what else does it work for? So one of the more common things that a lot of our clients use this for is for recapturing or paying off debt. Debt, by the way, is one of the most destructive things when it comes to building wealth and having financial certainty around the future. Interest and debts are very dangerous, especially high interest stuff. So let's look at an example. This is just an example of someone, okay? So let's say that we have a doctor. He's 45 years old. He has 9 third-party debts, $478,000 of total debts. That's quite a bit. The total payments that he's making every single year are $69,000 and change, or $5,777 per month. That's a lot going out the door right there. So this would take this individual 19 years to pay it off if they paid it off as, scheduled, okay? That's going to be a long time, a lot of money, by the way. So the total debts that this person has right now, it's $463,000, okay? So now let's look at an example. So this person is going to start a policy. We're going to do $25,000 deposit into an infinite banking structured policy. Now that's just an arbitrary number. It's the numbers that we are for you are not going to be the same. They're built just for you. Okay. Now immediately this person is going to have cash value of $14,000 and change available. Okay. So what we do is we borrow from our bank. We take a portion of that and we take that $14,000, we put it into the debt. So we pay off the Discover card, the Lowe's card, and part of the Nordstrom card. The total debt now drops down, and the monthly payment drops from $5,777 down to $5,329, or it got reduced by $448. Okay. So that's what happened the first year. Now, here's what happens in the second year. Another $25,000 goes into the policy. That's your second year deposit. The cash value goes up by $16,571. The payments back to yourself, that's that $448. So what are you doing with that $448 of monthly payments that's not going to the creditors anymore? You recapture it, remember? Recapture and recycle. So you recapture that $448, put it back into your policy, okay, the loan. Now you have an additional $5,000 and change available. So the total cash value available to borrow against is $21,945. So what do? Borrow that back out. You pay off the Nordstrom card, Wells Fargo, the private loan, and part of the BMW card, okay? Now what's happened? Your debts have dropped down to $378,000. Your monthly payment has been reduced by $1,917, okay? So this is just math. So year three, same thing. $25,000 goes back into the policy. Now the cash value is starting to accumulate, starting to grow faster because of dividends, by the way. So now the cash value has gone up by $25,541. The payments of $1,917 back to your policy have increased the cash value as well by $23,004. So the total cash available is $48,545. Once again, borrow from the policy. You're going to knock out the BMW, the West Marine. I'm assuming that's a boat, probably a pretty nice boat. And then you pay off a portion of the condo. Okay. Now your total debts are only $283,000, and the monthly payment has dropped by $3,677. All right. Now, before we get to year 4, quick question here. How much have we put into this infinite banking policy? Well, 3 years, $75,000. Approximately how much have we taken out? Approximately $55,000. Okay. So the question is, how much is left in your policy earning dividends? Okay. Remember I said uninterrupted compound interest. How much is left in the policy earning dividends? Stacy said it right there. Anybody else want to take a guess at this one? Come on, let's start calling people's names. There you go, Patrick. Okay, yep, exactly. It's not $20,000. Yep, it's $75,000. So even though you've borrowed from the policy, you've borrowed $55,000, you're still earning dividends, which compound, by the way, on the full $75,000. So if you understand that right there, like, you should be excited about this concept because it's pretty cool. Because I mean, that's uninterrupted compounding right there. It's amazing. It's amazing. All right. Okay, let's go back to year 4. Now in year 4, same thing happens. 25 goes in, cash value goes up by 26,000. The payments of $3,677 back into the policy have also increased the cash value by 44,000 and change. So the total cash value available is $70,439. What do we do? Same thing. Borrow from the policy, out of it, pay off the condo, or portion of the condo, and the debts have dropped by $187,000. Now, here's what's different though right now. So is the monthly going to drop? No, because the condo and the house are amortized loans. If you pay off the principal, a portion of it, the premium or the payments don't change. So nothing changes on the monthly payment side. Now in year 5, 25 goes in, 27 cash value goes up, payments back to ourselves is 44,000. Total cash value available to borrow again is $71,000, which we do. We borrow that out, pay off the condo and a huge chunk of the house. All right. Now the only debt you have left is the house. So monthly payments have dropped by $4,556. So now in year 6, we're going to do something a bit different. Year 6, we're going to open up a second policy because maybe this person has, got a raise, has more income, or they're just like saying, hey, I love this concept. I want to do more policies. By the way, you can do multiple. Okay. So what they do on the first policy, they reduce the premium down to $10,000. The cash value, you put in 10, the cash value goes up by $13,092. That's pretty good. On the second policy, year 1 for that policy, 25 goes in, $14,863 of cash value is available. Now the payments back to ourselves equals $54,678. All right. Total cash is $82,633. What do? We borrow a portion of that and wipe out the house. At this point, our debts are gone. We've recaptured $5,777 of cash flow. Now in year 7, we take that money, that 577, we pay back the policy loan, and all of a sudden the policy loan is gone. We're 100% debt free, yet we have an infinite banking policy with 6 figures of cash value inside of it that we can now start using to start building more wealth. So that's how you can really capture this. So keep in mind, that was 7 years. So they're going to take 7 years, then you're done, versus 19 years to pay everything off traditionally. And yet you have recaptured all that money. It's still in your policy, earning you dividends and growing year over year over year for the rest of your life with guarantees. So if you think about that, paying off debt traditionally versus what I just showed you, it's amazing how it can kind of flip your ability to build wealth. Pretty powerful. All right. And by the way, guys, any questions you have, remember, once again, use that chat box, use the Q&A box, whatever you want, but feel free to ask questions. I will stop and answer them as we go through this. Now, if you're looking at this thing I just showed you, saying I didn't understand the math on that, don't worry about it. We actually have resources and tools that we use to help our clients. So we have what's called a debt blaster. It maps out what I just showed you. Yeah, Tom says I need a breakdown. Exactly. So this breaks it down on a monthly basis, so that you can see exactly how the money's flowing. We did map it out for you. Yeah, because otherwise can get kind of complicated, but that's called the debt blaster. There's no cost to this kind of stuff, by the way. It's just stuff that we provide for you. But we run the reports for you and help you do it. But yeah. So think of it like a it's called our implementation team, by the way. We have a full team. We're not small, but it's your own personal BYOB, be your own bank blueprint. So we help you map it out. So Juan says, so do we ever pay the policy? I'm not sure what that means. Do we ever pay the policy? I'm not sure what that means. Pay the policy back, the loan. So in that example on the debt one, that's year 7. Yeah, so year 7, you take that 5777 that you've recaptured, and all of it goes back into the policy to pay the loan back 100%. And then that cash value is available it's like over $100,000 available to put it back into the policy. Yeah. Mario, what's a PUA? So that's called a paid up addition. So when you look at infinite banking, we use PUAs in multiple spots in the policies to build cash value. So PUAs are how you build the cash value. And so when I build the policies, I build it inside the premiums and all that kind of stuff so that we have cash value growth. But it's called paid up additions. All right. So now let's kind of go on to the millionaire part. And by the way, guys, once again, ask questions. I love questions. So here's some questions I do get. So what if I don't have any debt, right? What if I don't need a new car? Because those are the examples that I just gave. Can I still do this? Can I still benefit from privatized banking? By the way, absolutely yes, because guess what? That's where the fun begins. Once you've done these kinds of things, now we get our money working for us, okay? Because we've recaptured it. Now let's get it working for us. So what else can you use infinite banking for? So active real estate investors. So this is very common, very big for a lot of real estate investors. So wholesalers, flippers, buy and hold investors will use this. Commercial property. So I think like apartments, mobile homes, things like that. Private lending, private funds. So lending your money out to other investors, being the bank for other people, by the way. That's a pretty cool way to do it. I'm going to show some examples of that, by the way. Business owners. A lot of business owners use this as a line of credit or as a way to have what's called a key employee insurance. But you can definitely, business owners love this concept, by the way. It also allows you to take some of your money from the business side off the table so that you have that money for down the road. Stocks and options traders, if that's something you're into, they'll put their money through this first, then go do that. Startups. I actually do have a lot of clients that are doing startup businesses and using this. They're taking the startup capital, doing it through a policy first so they don't lose the future value of it. Yep. And then equipment flipping. So yeah, equipment flipping is another common way that people use this. And if you don't know what that is, think of like buying like a forklift, rehabbing it, and then leasing it back out. So yeah. All right. Juan says, thinking of contacting all the life insurance companies in my town. Well, so here's the thing. So it's specially designed. So your average life insurance person cannot do infinite banking or won't do it because they don't know it. Additionally, there's only a handful of insurance companies, and they're very large, by the way. They're not going to be the ones in your corners, in your town. They're not going to be those kind of insurance companies. These are very large companies, been around for 100, over 120 years in most cases, but they're mutual insurance companies. Additionally, a lot of agents don't do what I do or what my team does because they don't know how to do it. So that's why I say it's specially designed. It is not off the shelf. So just kind of be very careful when you do that. Juan says, so can we just open life policies from anybody? And no, please don't do that. No, there's a lot of horror stories where someone goes and tries to do that. 99% of like financial advisors and insurance agents can't do infinite banking or won't do it or don't know how to do it. And by the way, I've written policies for lots of life insurance agents. I've done it for financial advisors, financial planners, because they just don't know how to do it. So you have to be trained on how to do it. Just keep that in mind. What's a good contact for you? I have ideas. Yeah, I'll put it here in a moment. I'm going to put my contact information in here. So you'll have my email and my personal call link so you can reach out to me. Tom, so reach out to me. I'll do it right. I'll put my email in there right now. So Tom, there's my email address. Grab that and then just send me an email. And then I can give you some more information and stuff. But this is being recorded too, by the way. Can you issue multiple policies in the same calendar year? Yes. Yep, you can. And then Mario, there's my contact information too as well. Yeah. All right. So now what I want to do, and keep these questions coming, by the way. So I want to show you an example of private lending with infinite banking. So what does it look like if you're going to private lend to like another investor with infinite banking? So now we're going to kind of get into some of the numbers. Keep in mind that this is just an example. Your numbers will be your numbers. This is going to be their numbers. So in this example, what you're going to see here is this person put in year one, they put in $150,000. That's a $50,000 per year premium. You can see it right there. And a $100,000 dump in or lump sum. So they put a large amount in upfront to grow the cash value very quickly. Okay. You can see that over here, net cash value right there, $132,000 at the end of that first year. Okay. So that's a good policy. right? Now, let's look at year 8. We're going to go to year 8 down the road right here. So they have $66,722 of cash value growth. But here's the crazy thing. It grew by 66,000, but how much did they put in? Well, they only put in $48,594. Okay, so that's where the compounding comes into to play. So, oh, Mario, yes, send me an email and I'll get you get it immediately after this. All right, so they only put in 48,000, but the cash value grew by 66,000. So that's pretty good. That's a 37% cash on cash return in this policy. So right off the bat, that's very good. You're getting a lot more value than you put into this thing. Okay. Now, let's just say that you private lend this money, and let's use private or hard money rates, 12%. So let's say you take that 66,000 or the 531, by the way, that's the total cash value at that year. You take it out and you private lend that money, okay, at 12%. You're making 37% cash on cash already. You're paying your bank back or the insurance company back 5% for that loan, which is a 44% cash on cash return. Okay, that's pretty good right there. So we did nothing different other than where the money went first. It went through the infinite banking policy. If it had not gone through the policy and just went to the private lending, you would have made 12%. But by setting up infinite banking, keep it in mind, marathon, building wealth, you got a 44% return on your money. So the question is, would you rather make 12% or 44%? Be your own banker. That's why, because you can make those kinds of returns. So think about how much faster you can start to build wealth if those are the returns you are getting on your money. Make sense? Kind of get your brains thinking right there a little bit. It's like, oh my gosh, that's pretty cool. Yep. Now keep in mind, doesn't matter if these are large numbers or small numbers. It's the same kind of concept, right? Now, what I want to share with you really quickly is the power of interrupted compound interest. So most interest that you earn is interrupted, meaning it will fluctuate, or if the markets go down, it goes down. You can have negative years or 0 years, okay? In this one, you have consistency to the point where, so in this example, this person put in a $50,000 dump in or lump sum, and they put in $5,893 per year, okay? And the cash value available in that first year was $51,000, okay? But here's the crazy thing. So in year 5, their cash on cash return is 26%, and access to capital is 126%. Now, that's not including what they may have used the money for outside of the policy. This is just the policy itself, okay? Year 15, they get 115% cash on cash return and a 215% access to capital. So you can see how this thing is starting to snowball. I mean, and they snowball very fast, by the way. So year 10, 54% cash on cash and access to capital is 154%. Let's just go down to year 25. 281% cash on cash return and a 381% access to capital. So that is the power of uninterrupted compound interest. All right. So the millionaire method. So here's how you become that level. Okay. The 5%, as we called it, right? How do you eat an elephant, right? It's one bite at a time. And the man at the top of the mountain did not fall there. And so if you ever see someone that's at that top of the mountain, figuratively, right? They're at that level of success. They didn't usually fall there. They took that first step, right? They took that first step. And that's what infinite banking is about. You got to plant that seed and start getting this thing rolling, because it will help you get to that top of the mountain, but it's one bite at a time. All right. So the machine, it works for debts and expenses, vacations, homes, taxes, and everything else. Okay. So it works for a lot of things. Now, one thing I want to share with you really quickly here, if we continue to pay back the home and the condo, remember the doctor, the debt? If we paid back the home and the condo as promised, how much would that have cost us? Okay. The condo and the house. Okay. So the condo payment was $879 per month, 251 months. That's $220,000. The house, $1,221, 224 months, $273,000, or total of $493,000. That's how much we would have paid out. Okay. That's a lot of money. That's to the bank, by the way. We paid that to the bank. All right. Now, we'd own the houses, but we'd be out of pocket $493,000. Now, because our policy, let's say it has 4%. I'm being very conservative. They're actually at 5% to 6% right now, by the way. Let's use 4%. Let's say that if that money, it never left your policy, so you funneled it through your policy first, recaptured it, so you're netting that amount, okay? But you still paid off the house and the condo, okay? You still paid them off. So how much would be in your policy now that you ran the money through the policy first? Okay, there's the numbers right there. It's a total of $749,000 you'd have in your policy that you can use now to go do other things with. So first option, you're out of pocket $493. The second option, you have $749,000 in your policy that you can start leveraging. That's a huge swing. That's a swing of over $1 million of net worth, by the way. That's pretty cool. Now, if you're saying, well, Brian, I don't understand what you just said. Once again, we have software that we do this for you, so you don't have to worry about it. So that's called the gain projector. So if you're a real estate investor, I recommend that if you're going to do a policy, you want to see how they work, use our software and it'll show you the money. It'll show you the flow, the best way to optimize the policy and the opportunity to make the most amount you can. Okay. So that's called the gain projector right there. All right. So now that you know what this is, and by the way, I have more slides. I have a lot more, some really cool information I'm going to share with you. The next step is go to brian.beyourOwnbanker.com/TBCT. So I'm going to go ahead and put that in the chat box as well so that you guys can grab that link. And that's at my personal call link, by the way. So that's my personal call link. And you can schedule a call directly with me. All right. So the link's in the chat box right there. So if you guys want, and that's my personal calling. So you and I will hop on a call, go through any questions you have and look at what this could be for you. So yeah, so use that. And I'm also going to put in, once again, I'm going to put in my email address. So if you guys want to get that link to the books or you want to just, contact me, that's my personal call link right there. All right. So this slide right here is kind of funny. I just like to share this slide. So one of the biggest switches we have to make when it comes to mindset and wealth is getting our money working for us instead of us working for our money, because unfortunately, most of us trade time for money, which means we have very little time to get our money working for us. Infinite banking can help you make that transition. That's one of the things I just truly believe about it. Okay. All right. Now, by the way, we didn't talk about the death benefit. I'm going to talk about that here in a moment. I'm going to kind of explain to you what that is. Also, the loans. So we're talking about loans when you borrow from those. We're going to talk about those. Those loans, though, never have to be repaid. They should be, but they don't have to be, by the way. The internal values inside infinite banking grows tax-free. Not tax-deferred, by the way, tax-free. The policies are exempt from judgments and liens in most states, by the way, and you can create tax-free income in retirement. So who would like to have tax-free income in retirement, right? Obviously, we want to have that. So this can help you do that, by the way. Yeah, me, Jeremy, I'll get to that in a moment. Good question, by the way, but I'll get to it in a moment. Yeah, Pavel says me. Yep, absolutely. All right. So let's talk about the death benefit. So we don't really focus on it, but it is there. So one of the things you'll notice on this policy, so this person put in $20,000 for the first 5 years, and then they dropped it down. So you can, remember, it's not an increasing premium, it's a decreasing premium, okay, deposit. The death benefit, you'll notice, though, is always going up. So look at this. It starts out at $325,000 for this person. In year 7, it is $500,000 almost, okay? So it's always increasing, but that is guaranteed tax-free, okay? So day one, this person puts in $20,000. If they got hit by that proverbial bus, hope it doesn't happen, right? They've created $325,000 of wealth, of generational wealth tax-free off of $20,000, okay? And that is guaranteed, and it'll keep growing and growing for the rest of your entire life, okay? So it's a great way to kind of lock in generational wealth for you and your family. So I do that for a lot of people, by the way, kind of walking through how that looks. Okay, policy loans, okay? So you're borrowing from your policy. All right. The policy loans are guaranteed, okay? They're guaranteed. Ask and you shall receive. There's no credit check, no approval. You'll get that money right out. Loans are private. So this is kind of a cool thing. So infinite banking is a private strategy, meaning it does not show up on your credit report. So the loans that you borrow from the policy also do not show up on your credit report. That's a very good thing, by the way. There's no minimum or maximum payments back to the policy loan. It's up to you. If you miss a payment, who do you go talk to? Go look in a mirror, by the way. That's who you talk to, right? So there, you are in control of the loans. So that's something that's very important to understand, is that you're in control. If you miss a payment, nothing happens on your policy loans. So keep that in mind. All right. Next question I get quite a bit is, how can I fund my bank? How do I fund this policy? Okay. A couple different ways. So you can do it monthly, you can do it quarterly, you can do it annually. All right. So it's up to you how you want to do it. And you can switch that during the life of the policy as well. What's the minimum? So if you want to start a policy up, what's the minimum recommended? 10 times your age per month. 50 years old, 500. 20 years old, 200. There you go. Pretty simple. That's the minimum recommended per month. Okay. The maximum depends upon your gross income and your gross revenue. It's a percentage of that. 15%, 30%. It's based upon your personal situation, the maximum you can put in per month or per year. Okay. On top of the premium deposits, that monthly, quarterly, or annually, you can fund it with a large dump in or lump sum. So let's say you say, hey, Brian, I want to do 10,000 per year, but I've got $50,000 sitting over here in the bank that I don't want sitting in the bank. Can I put that into the policy? Absolutely, yes, you can. So we can fund these things and really get that cash value there within the first 30 days very high, right? So yeah, so anywhere from 50 to 90% or more can go to the cash value within the first 30 days. So this is unique. So you can borrow from these things right off the bat, right? Now, the other question is, would you put in $1 to get $3 out? Yep. So the longer you fund these things, the more efficient they get, the more exciting it gets. So let me show you what I mean by that. So on this example here, this person put in $10,000 annual premium, like I mentioned, and a dump in or lump sum of $50,000 day one. At the end of the first year, they have $55,000 of cash value available, and they put in 60, okay? Because you got to capitalize the account. Now, how's it look down the road? In year two, they put in 10,000, and they have $10,607 of cash value growth. They're already cash on cash positive, which is amazing. But look at this. In year 11, we decided to drop the premium down to $3,120, but the cash value went up by $10,590. More than 3 times what they put into this thing. So that's incredible. So think about, and that's going to get better and better and better every single year for the rest of their life. It just keeps getting better and better. So that's an example of how these things can work and how they can look. This is a Warren Buffett kind of quote, and it says, if poor people would just do what the rich people do, they wouldn't be poor anymore. I don't quite agree with that. I like the quote, if poor people just knew what rich people do, then they wouldn't be poor anymore. It's the mindset, it's the knowledge, right? Right? So you got to be able to have that right knowledge. So that's what we're talking about here today. Let's see here. Jeremy said, yeah, so how is this different than an IUL? So yeah, that's a good question. Index universal life. So let me get to that here in a moment. I think that's the next slide, I think. So why should I work with you, Brian? So I've been teaching infinite banking for over 8 years now. We have an entire team that works with you, over 30 people on our team that to help you set up infinite banking, the concept. Our team is the largest producer of infinite banking for most of the large insurance companies that do infinite banking. I have over 100 clients right now in underwriting. I think total we have over 700 right now in underwriting. So the insurance companies, they like us a lot. So we have quite a bit of resources and pull with the insurance companies. And we also have ongoing support and services. So when you have a policy with us, we support you on an ongoing basis after the policy is in place. That's a big difference, by the way, between other people. If you don't know how to drive the infinite banking vehicle, like the car, right? It's not going to be as efficient. So you need someone that's going to teach you consistently how to use it, how to optimize it. That's what we do. And it doesn't cost you anything. There's never any fees or things you pay to us or things that we charge you, by the way. So once again, ongoing support, ongoing services is a big deal. We do live events, by the way, virtual and in-person events throughout the year. Okay, so this is for you who asked that question, Jeremy. So is IUL or VUL infinite banking? Flat answer is no. That's a personal choice opinion, but I'm going to say no right off the bat. So IULs and term insurance, by the way, pay some of the highest commissions that exist. Okay, infinite banking, we take about a 70% cut in commissions to do infinite banking. IULs, by the way, pay high commissions. That's why they're being pitched all over the place. But IULs are complicated. Additionally, one of the things that I truly believe in is that in order to really build wealth or be in control, you have to remove your money from the systems that are broken. Think of the banking system. Think of the markets. Think of like Wall Street. Think of the IRS, the Treasury. All those things are really just manipulating your money. And IUL is tied to the markets, which is the exact thing we're trying to not be tied to. Volatility, by the way. I don't want to have my IUL tied to those markets or my policy. I want it not tied to them. I want it tied to the performance of the insurance companies who have never lost money. In I think One America, 150 years, they've never lost money. That's where I want my money. So yeah, so we don't touch IULs. We only do infinite banking, by the way. And Nelson Nash, who coined the phrase infinite banking, and they have an institute that certifies people like me. If you do IULs, you cannot even be part of their organization, part of Nelson Nash, which is the core of infinite banking. So yeah, we don't touch IULs. I have too many horror stories of clients that have IULs come to me and are all upset, and they have to do something different because they got sold an IUL that did not perform like they thought it would. They didn't know how to use it, and it imploded. So it's just too many horror stories. So we don't even touch them. One of two things will happen to us in life, right? Okay, we're going to live. Okay. Are we better off with or without infinite banking if we live? I'd say with it. We also know that we are going to die. Are we better off with or without this in place? Well, I showed you the generational wealth. I showed you the guarantees. So in my opinion, definitely better off with this in my life, right? Okay. Now, and here's the thing though, let me tell you a story. So this is the tale of two people. So I used to be the guy on the left, right? Not figuratively, not literally, but I used to be that kind of guy that was like, I'm going to keep doing what I've been told to do. I'm going to keep on this path, right? And that's what I did for many, many years. Okay. I don't need to do anything different. And I had so many painful lessons that I finally had to change. But what I realized was this, is that wealth is always being transferred. Okay. It's always being transferred. And there's two groups. The one group that is being transferred from, and the one group is being transferred to. And I realized that if I continue doing the traditional things in life, having debt, loans, mortgages, all these things, I realized that I was group one. Wealth was being taken from me. But where was it going? It was going to group two. Okay. It was going to corporations. It was going to government, IRS, going to banks, by the way. And so I kind of made it, one of my missions is how do I become group two? And infinite banking was one of the ways that I came across through my journey that I realized was one of the best ways I have ever seen to be group two, which is where wealth is transferred to, not from, but to. That makes sense? So the question is, you can stay in group one, beat your head against the wall, which is what I did for years, or go to group two. Now, here's the thing. So what do you do next? Grab my call link. It's in the chat right there. I'll put it in here again. But all we do is we hop on a call. Let's solve your problems. Let's answer your questions. And let's just see if infinite banking is a fit for you. I am not going to sit here and tell you that it is a fit for everybody. It is not. I am not going to say that. But if you want to be one of the 5% or 10%, this is one of the best ways I've seen to get to that level. Okay. So the last thing I'll end on here is this quote from Will Rogers, because I mentioned it at the beginning. I'll mention it here again. The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. All right. Now, once again, we've been taught, certain things around money, and I've challenged the way that you may think about money in this presentation. Okay. I know this is a lot of information I threw at you. So this is being recorded. So if you guys want to watch the recording again, go for it. If you guys want to hop on a call with me and go through any questions you have, your situation, I'd love to do that as well. But any questions you guys have right now for me, who is infinite banking not for it? So who is infinite banking not for? Good question. So if you're so as an example, and I'll give you some examples of people that I've worked with or I've talked to that I told them it's not a fit for you. If you're retired and your only income is Social Security, if you're spending more every month than you're bringing in, it's not going to solve that problem. It's not if you're negative cash flow and you're digging that hole, it's not going to solve that. I'm just being honest on that one. If you're it's not going to be for you if you're severely unhealthy. Okay. Now, doesn't mean you can't do it, because infinite banking, you can do policies, you can own a policy on somebody else. So that's a very common thing that we use infinite banking for, is to like a grandfather or a parent will own one on somebody else, a spouse or an adult child or the juveniles, that kind of stuff. So you can own them on other people, by the way. So there's ways to get around that one. But that's a lot of times who it's not for. If you're not a citizen of the US or Canada, it's not going to work. You have to be a citizen of US or Canada for this to work. If I'm an agent and do IULs, is there a conflict? No, there's not. I've set up policies for actually many agents that do IULs, by the way. So I've done it many times. I've set this up for Dave Ramsey coaches. If you guys know why I'm saying that, you'll understand. But yeah, I've had coaches come and, or his coaches certified, come to me and realize, hey, I saw your presentation. Can you do this on me? So yes, I've done it for them too. Yeah. But yeah, and you can also own policies on juveniles. That's one of the best ways to do generational wealth, is just, for the next generations, like the third, fourth generations, is do policies on juveniles that are under 18. Very easy to do. Yeah. So oftentimes we'll do what's called the waterfall method or the family banking method. So family banking, by the way, is where you use like trusts and things. So a trust can own a policy, a LLC, an entity, a corporation can own a policy on somebody. Okay. And so we'll do like what's called the family trusts, where a grandparent will own a policy on themselves, on their adult kids, and then on their grandkids. And then the family trust owns all the policies and also is the beneficiary to all the policies. And so it's a way to keep the money in the family and protect it. So, but that's something we help people set up. Yeah. So any other questions? I'll give it a couple seconds. Otherwise we can call it a day, but yeah. And then guys, also you can use my email address if you have questions that you think about after the presentation, reach out to me, etc. Schedule a call with me if you want. And we can go through those. And also if you click that link, the brian.maker.com, you should get access to the, you can see the books, the PDFs that I said you can get for free. You should have those in there. Or if you just send me an email, I can send you the link directly. Abby says, can you dump funds from HELOC and return after a month? Yes, you can. You can do that. So I've definitely have a lot of clients that are doing that. You just got to understand the cash flow and make sure that it makes sense for you. But yeah, so what happens is you borrow from the HELOC, goes into the policy, then you take the policy, the cash value, borrow back out again, and then you can go do something else with it. So if you're going to put that money to work, go do that. And you can do what's called velocity banking on the HELOC to take care of that if you want. But you got to understand the cash flow and just make sure that it makes sense. Yeah, JD, appreciate it. Thanks, man. Yeah. All right. If there's no other questions, I'll let you all go. Oh, yeah. So yeah, Yvonne said, yeah, thanks. No questions, but thank you for the presentation. I hear it differently every time and it's good. So yeah, a lot of people here have come back quite a bit and seen the presentation. Other people give the presentation as well, by the way. And they have a couple different answers or slides and things like that. But I appreciate it, Jeremy. Yeah, and yeah. Hope all is well going. Yeah, it's cold up here in Patrick, but we definitely we got our freezer full of venison, put it that way. So we're very happy in that regard. Abby says, I think my children and I should be ready for a family trust. We'll set an appointment. Great, sounds great. Yeah, definitely looking forward to talking to you, Irina. Great. All right, everybody, take care. Have a great rest of your week. Stay safe, and if I don't talk to you guys before the end of the year, happy holidays, Merry Christmas, and Merry New Year. Yep, Pebbles, yeah. Jeremy says, it's only 65 degrees in Florida. Yeah, don't tell me that. That's funny. Yeah, right. Yep, Pebbles, agreed. All right, take care, everybody. Talk to you all soon.